real estate funds. What are they? How do they work? And what are the pros and cons? That's exactly what I'll be walking you through in this video. And just in case we're meeting for the first time, my name is Seth Ferguson. I'm a 14-year real estate veteran. I'm the founder of the Multifamily Conference, a huge international apartment investing conference that's coming up in May 26th to 28th. And I also partner with investors to invest in large apartment buildings. So do me a favor, hit the subscribe button so you don't miss more videos about building wealth through multifamily real estate. So let's get right into it and talk about real estate funds. Let's start with the first question. What is a real estate fund? What are they? Well, a real estate fund is really a structure that's employed to acquire pieces of real estate. So just like there's syndication, I'll put a link right up here to a video I did explaining everything you need to know about the syndication side. Just like syndication, a real estate fund is a type of structure, a way of structuring and layering different roles and responsibilities and who brings all the money, all of that sort of stuff. It's a way of acquiring real estate. So how do funds actually work? What are the different pieces and components that actually make this thing happen? So this will be me getting the whiteboard really messy now. So there are two components to a real estate fund. So let's start right here. So this side is called the limited partnership, the LP, and this is made up of passive investors. So I'll just go passive investors, just like that. Unlike a joint venture or buying a property yourself where you're assuming unlimited risk, a limited partnership structure, an LP, actually provides the passive investors with a lot of protections under the law. So their risk exposure is not as big, and that's why it's called a limited partnership, because their risk is limited. This is really, really, really important. And I've done videos before, so I'll put a link right up there to one I did explaining about the differences in terms of risk between a joint venture or partnership type of structure and some more sophisticated structuring like funds and syndication. What happens is these investors over here, they all individually have funds that they want to invest. Maybe it's 100 grand, 2, 3, 500, 800 grand, $1 million, whatever it is. And they want to be able to passively invest in real estate. They want to get the strong cash flow. They want to participate in the upside, the appreciation. They want all the tax benefits, but they don't want to devote the time, assume the risk, because they're busy. They're running their own businesses. They're busy professionals. Whatever they do to put bread on the table and advance their career, they're busy doing that. They just want to put their money to work and have it run by a professional management team who knows real estate, who has the connections, who hunts the deals, all of that sort of stuff. Plus, the management team assumes greater risk. We already talked about the risk. So these investors, they pool their funds together in the limited partnership. Now, these funds are actually controlled by what's called the fund manager. So I'll just put management right here just to keep things simple. So like I said, the fund manager, the management team, the general partnership, they have the track record, they have the deal flow, they know what markets they're in, why they're in those markets. They have the business plan, so how they're going to create value in real estate. And I'll put a link right up here to a video I did explaining all about the value add strategy. So how we force appreciation with apartment buildings. So the fund manager, they have all the experience, they bring everything to the table, but they don't have the capital required. And this is what the passive investors bring, the limited partnership. And the fund criteria basically outline, the types of deals the fund's going to be acquiring, the areas, the rough business plan. So basically these investors, they review the fund criteria and say, you know what, this looks really good to me. I'm really happy with their experience, the fund manager. I'm confident in their ability to perform based on the fund criteria. I'm going to invest my money. So the limited partnership here, they will invest their money under the control of the fund manager, and then the fund manager will then go out, the fund itself will go out and acquire properties. So this is the fund itself. So with the syndication, usually I draw a single building because a syndication is for a project, a deal by deal basis. With a fund, basically what will happen is the LPs are plugged in here, the fund manager is plugged in here, and the fund will actually go out and acquire a deal. So they'll buy a deal, they may buy another deal, and then they may sell a deal at some point. And the fund basically has a life of its own. And some funds can last for 10 years, 15, 20, 30, 40 years, 50 years. So a fund is really like an entity or has a life of its own. It will grow, it will shrink, it will expand. It'll go through different periods of the fund. And basically what will happen is the passive investors, instead of investing in a single project like with the syndication, their money is diversified throughout the entire fund. So let's say the fund has 50 properties or 20 properties. The limited partnership actually owns pieces of all those different properties. It's not just a single property like with the syndication. And of course, there's profits, right? So, and of course, there's profits, right? The fund, the whole idea of the fund is to put the money to work and make it profitable for the limited partnership, the passive investors. And profits are paid out according to what's called a split. So one split could be 70-30 with one fund, so meaning that 30% of the profits go to the fund manager for running the deal and all that stuff, and then 70% goes to the limited partnership. It could be 25-75, it could be 60-40. It really depends on the types of deals, the risk exposure there for the general partnership as well as for the limited partnership, the time, energy involved. Many different factors go into determining what's called a split. And of course, there are fees being charged. Typically, there's an asset management fee, so a percentage of the total dollar volume under management. That could be 1%, 2%, 1.5%, whatever it is. And there are other fees built into the deal. I don't want to get too bogged down in the fee side, but basically what you have to know is that the profits are paid out according to a split, and then there's fees that are charged as well in the fund structure just to support the fund and make sure it's able to go out and acquire more properties and really do what it's built to do. So let's get into some pros and cons with the fund, and I've kind of dropped a couple as I went through the video here. So let's do some pros and cons. Let's start with the cons and then we'll switch over to the pros. We'll mix it up from the way I usually do it. So some cons with the fund. Well, if you are an investor who wants to have control, ultimate control over exactly where your money goes, so you want it to vet every single opportunity, a fund won't give you that because your money, you are investing your money in the fund. You have your fund criteria that you're subscribing to, but then the fund manager will go out and use and deploy your capital as they see fit. So if you want to know exactly what deal they're doing and how your money is being deployed, well, a syndication is probably better for you, because with the syndication, you can say, I really like this deal, I want to invest in this one, or no, this doesn't really fit what I'm looking for, I'll pass and bring me the next one. With a fund, you don't have full control of how your money is deployed, because that's what the fund manager is paid to do, to go out, put your money to work in the way that they feel is best for you and the fund as a whole. Another con with the fund, and this kind of goes hand in hand with syndication and more sophisticated structuring, is not very liquid, right? So it's not the type of investment where you can invest one time and then 6 months later you want to exit. These are long-term real estate investments, and typically you're in the deal for 3, 4, 5, 7 years, depending on the type of fund or the type of syndication, that sort of thing. So they're not very liquid. Now that is a big benefit to a lot of people, but also it could not be a benefit, and it could be a con if you're looking for that sort of thing. And then the other con I just want to talk about is funds are not accessible to everybody. Generally speaking, you must be an accredited investor if the fund manager is going through the exempt market, and that means there are income requirements to investing in a fund, these types of deals. Like, they can't be publicly advertised most of the time if they are going through the exempt market in terms of raising funds. So they're not accessible to everybody, and like I said, you have to hit income or net asset requirements to be able to invest. Now let's talk about some pros, because there are a lot of pros to either investing in a fund or launching a fund of your own. Well, the first pro would be the money is there when you need it. So unlike a syndication where you acquire the asset, you lock it up, and then you have to raise the funds, the money's already sitting there in a fund. So oftentimes, depending on market conditions, you can use that to your advantage and pull the trigger pretty quickly and be able to close very quickly. And depending on the situation, that can prove very advantageous in terms of the terms you are able to get for that acquisition. And then diversification, I already mentioned that, but instead of investing in a single deal, your investors all their exposure is in that one deal. With a fund, you're diversified across the entire portfolio. So that could be 10 properties or 20 properties, 50 properties, 7 properties, whatever it is, but your money is spread out, or the investor's money is spread out. And that could be in just one market, that could be in many markets. It all depends on what the fund, what their business plan is, and what the criteria state. And the last advantage I want to talk about is when you're a passive investor with the syndication, you invest your money, and then when the syndication, when they wrap it up, when you exit that deal, you have to find another deal to put your money in. With the fund, you invest in the fund and your money just keeps working. It moves from one deal to the next deal because they're all happening inside the fund. You're not out shopping for the next deal because the money's already there and it's already working on the next deal. So it is a different way of doing things if you're used to investing in syndications, and it all comes back down to what works best for you. How much control do you want exactly where your money goes? How much diversification are you looking for? All of these things go into determining whether or not a fund is best for you or a syndication. And if you're looking to learn more about how you can really scale your real estate investing with multifamily real estate, apartment buildings, maybe using a fund, maybe syndicating the deal, you really have to come out to the Multifamily Conference. It is happening May 26th to 28th, 2023, downtown Toronto. We've got Grant Cardone coming, Alex Rodriguez, who's invested in over 15,000 apartment building units. It is going to be insane. Go to multifamilyconference.ca and reserve your seat now because prices keep going up and they will keep going up until the day of the conference. So lock in early and get the lowest price available. And if you like this video, if you found this useful, hit the like button, leave a comment, let me know what you think. And until next time, happy investing.